GoldMining Europa Week 24, The Crucible. Let's jump right into this explainer. Today, we're taking a deep, institutional-level dive into our dedicated EURUSD Cent account. And honestly, we are stepping into a period of trading that truly, literally earned its title this week, The Crucible. It was a week defined not by easy wins, but by absolute extreme market testing. Before we get bogged down in the heavy data and market mechanics, we really need to set the baseline here. This is a dedicated real EURUSD Cent account. We started out with exactly 2,500 cents, which, if you do the math, is roughly $25. And look, keeping everything denominated in cents, that's completely intentional on our part. It gives us this incredibly transparent, granular view of the algorithm's raw mathematical mechanics, totally stripping away the emotional baggage that comes with massive dollar amounts. It just grounds the whole analysis in reality, Strip away the zeros and you get the pure, unfiltered performance of the strategy in live market conditions.
Okay, let's dive into this. If you open this explainer expecting to see massive, aggressive profit spikes, well, honestly, you're looking in the wrong place today. The core story for week 24 is entirely different. The story this week is all about resilience. We're talking about how a trading strategy survives, adapts, and just pushes through truly extreme market pressure. Because in professional trading, right, growth is great, but survival is mandatory. The market is always going to throw periods of intense chaos at you, and a system only really proves its true worth when the conditions turn downright hostile. Macroeconomic drivers injecting EURUSD volatility. We had U.S. inflation data releases, shifting Federal Reserve expectations, volatile Treasury yield movements, a changing ECB outlook, and broader dollar strength. So to really grasp the pressure this account was under, we have to look at these massive macroeconomic drivers. We saw intense volatility pumped straight into the EURUSD pair. We had major U.S. inflation data releases that were constantly resetting the baseline. Add to that shifting expectations around the Fed, crazy volatile Treasury yield movements, a rapidly changing outlook from the European Central Bank, and this relentless wave of broader dollar strength. These aren't just flashy headlines. These are massive institutional forces translating into real, physical chart volatility. When these forces clash, liquidity shifts in a heartbeat, and the algorithms have to process an overwhelming amount of conflicting data in real time. And this brilliantly illustrates what that macro chaos actually looks like on the ground. Check out those incredibly sharp directional swings. Market sentiment was violently whipping back and forth, and the automated strategy was basically forced to execute entries right in the thick of these massive whipsaws. Take a second to just absorb that intense price action. Imagine the sheer pressure on the automated systems here. Every single sudden drop, every aggressive reversal, that's an algorithmic decision point. It's the strategy's risk management parameters being pushed to their absolute limits by rapid shifts in global capital. Which brings us to the reality of trading through those wild conditions. This right here is the emotional core of our week, a real crucible moment. On June 8th, the account took a brutal hit, suffering its biggest losing trade of the week at minus 70.71 cents. But here's the kicker. It didn't fold. The strategy immediately absorbed that blow, pivoted, and executed a recovery, locking in its largest winning trade at plus 77.51 cents. Remember, these are real cent values, real capital on the line. The system processed the hit, recalibrated based on the changing volatility, and systematically executed the exact recovery trade needed to pull the account right back from the edge. Surviving the reality of rapidly changing market conditions. Let's be real. How do you absorb a heavy directional hit like the one we just looked at, and then pull off a precise mathematical recovery without the whole account just blowing up? Well, that is the ultimate test of any system's risk management protocols. Just about any system can make money when a chart moves in a straight line, but the true mark of a robust strategy, it's how it handles being wrong. It's all about damage control, smart position sizing, and that cold, calculated execution of recovery mechanics when market sentiment suddenly flips on you. Let's take a look at how that risk actually played out over time. Even with all the macro chaos, the central bank rumors, and those violent directional swings we just talked about, the floating drawdown was kept incredibly well controlled. The system gave the trades the breathing room they needed during the wildest market moves, and this is absolutely crucial, it never let the risks spiral out of control. It bent, but it did not break. That is the very essence of controlled drawdown. You're giving the trades space to weather the short-term noise while keeping an unbreakable, hard ceiling on your total account exposure. So the crucial point is it all boils down to this one single vital metric, 1.26%. Through every data release, all the Fed speculation, and the massive chart whipsaws that triggered both our biggest wins and biggest losses, the maximum weekly drawdown stayed incredibly contained at just 1.26%. Literally, 1.26. That figure alone is a massive testament to the defensive architecture hardwired into this strategy. It proves, without a doubt, that even when taking its hardest hits, the core capital preservation logic did exactly what it was built to do. When the dust finally settled on this crazy week, here is our end result. A very hard-fought, modest gain of $13.92. In percentage terms, that's a 0.55% growth for the week. Now, sure, that might look pretty small on the surface, but when you really consider the intense crucible this account just went through, securing literally any positive growth while keeping the drawdown that unbelievably tight is a massive operational win. Seriously, it's a victory of solid process over pure profitability. Now, looking at the full weekly picture of the balance and equity fluctuations really reveals the journey here. If you follow that purple equity line, you can trace exactly what the week felt like: the deep dips when the market was piling on the pressure, the absorption of the floating loss, and then finally that hard-won stabilization as the strategy worked through its recovery trades and secured the net gain. It's basically a visual map of strategic survival. Every little fluctuation is the algorithm literally fighting its way through shifting momentum to secure fractional advantages. Let's move to the macro view and see how this builds into the broader long-term progression. The total account balance now sits at $2,562.54. That's a total growth of 2.50% since we launched. When you juxtapose the crazy localized volatility of week 24 right up against the super stable upward long-term trend, the strategy's whole intent becomes crystal clear, right? It is absolutely about pacing the marathon, not sprinting the mile. All that short-term turbulence just gets smoothed out by long-term statistical consistency. The objective, disciplined progression toward the 10,000-cent target. We always want to keep our assessments grounded and realistic with you guys. Yes, the account is still above its starting balance, and yes, total growth is slowly improving, but we have to acknowledge that meaningful drawdown still exists. The markets are just inherently unpredictable. But our core objective hasn't changed at all. It's all about disciplined, methodical progression toward that 10,000-cent milestone, because once it hits that target, the strategy might actually be offered up as a public copy trading signal. So it's a slow, highly calculated climb that prioritizes foundational stability over everything else. Real accounts, real risk, real progression. Which brings us right to our final takeaway. This journey, it isn't about chasing those crazy, aggressive, short-term returns you see all over social media. It's about looking the real risks of the market right in the eye and managing them completely transparently, week in and week out. And I think that leaves us with a pretty compelling question to think about. If a strategy prioritizes survival over sudden wealth, does it fundamentally change how you view the path to actual long-term market success? Think on that. Keep learning, respect the risk, and keep watching the progression.